Hey guys, we're talking today about life insurance. So welcome to chapter 11. I know that we did this chapter and chapter 12. We did a lot of it in the fourth parcial, but we're going to go back over it so that we're doing it with enseñanza and different things like that so we can understand it better. Repetition is the key to learning, and honestly, this stuff is important to learn, okay? This is, in Spanish, what? Seguros de vida, okay? I already verified that these are sold here, and they are in every bank. You can get life insurance. Okay, obviously you have to be careful with them, make sure that they're good and worth it, but so we are going to talk about it today so that you understand what it is. Okay, so that's what we're going into today for chapter 11. It's investments, different ways to invert your money on things that are necessary to think about the future. Okay, you can't just be spending money for today. You can't just be saving money for tomorrow. You need to be thinking about your future always to be wise stewards of your money. Okay, so we're going to be talking about 3 different types of life insurance today: term, lifetime, and endowment. Okay, so I just wanted to highlight those 3 words before we get into the text today. So let's go ahead and read it together, and then we'll see the math that's involved. The primary purpose of life insurance is to provide financial compensation to your dependents following your death. Okay, so even though it's called life insurance, it's really for when you die. Okay, and you are going to be able to take care of or help take care of the people that you love, the people that are dependent on you. Okay, you know, husband and wife together, one person dies, the other person inherits the life insurance, or your children. Okay, so you can have the security knowing that they're going to have help after you die. The amount of life insurance you need depends upon how many people financially rely on you. For instance, a single person supporting only himself needs much less life insurance coverage than a married man with small children. And you might think to yourself, like, why would a single person even need life insurance then if no one's dependent on them, and obviously they're not going to need it to live after they die? Well, because actually life insurance can help pay off your debts, and life insurance can also help pay for your funeral. Okay, so those are some things that you need to keep in mind so that that's not a burden to family members. Okay, your parents may have purchased an insurance policy for you when you were born, or they may have a family policy with a rider on it that covers any children in the family. Okay, so it I don't know if it's common here, but like in the States, it is very common that a family will purchase life insurance for the children or add them to their plan as a dependent of them. Okay, the thing about making you a rider is that eventually you're not going to be a rider anymore, because eventually you're going to be on your own, right? And maybe they don't want to be paying for you to be on there, right? And that you have to be paying for your own. The 3 major types of life insurance, like I told you, are term, lifetime, and endowment. So we're going to talk about term. Okay, what you need to know about term is that it's basically the most basic one. Term life insurance is the least expensive and provides temporary protection for a specified number of years, such as 5, 10, or 15 years. The insurance company pays if the policyholder dies within the specified time, okay? Which doesn't really sound very nice, because like if you buy term life insurance, you have to die within 5 years or 10 years or 15 years of buying it. Okay, so that's why it's the most basic, because you could be paying for something that you never even use. Okay, if you bought a 5-year term insurance but you didn't die, well, now you got to buy another one. Okay, it didn't do anything for you. If the policy holder dies before the expiration of a term policy, the beneficiary, which is the person named to receive the death benefit of the policy, okay? It's weird that they talk about it like that. Okay, you receive the benefit of them dying, okay? But honestly, guys, people have killed people for their life insurance plans, okay, to be the beneficiary, which is not... It's a weird situation, okay? So, but it's true. Someone is going to be... What they mean by benefiting is not that they're benefiting from your death, but somebody gets the benefits of the insurance, okay? The beneficiary, the person that receives the benefits financially, and will receive the face value of the policy. So what is face value? Face value is the amount of insurance coverage purchased, okay? So when you say amount of insurance coverage purchase, like let's say that you want to be covered for $100,000, okay, that you're going to have these expenses for $100,000 after you die, the funeral, selling the house and different things that you're going to take care of. You're not going to be paying $100,000 to the insurance company. You're going to be paying monthly payments, and then they're going to commit to spending whatever is needed that the beneficiary says is needed. Okay, so insurance companies, I've taught you guys this before, they work at risk. Okay, for example, like if you have a car worth $20,000 and you buy insurance on that $20,000 car, you're going to be paying, let's say $100 a month to the insurance company. They're taking the risk that you're not going to get in an accident and have to pay $20,000 on your car. Okay, they're gaining $100 a month at the risk that they may have to pay out $20,000 to replace your car or something like that, right? Okay, well, not everybody's going to get in an accident. So let's say that you have 10 people inside the insurance company paying $100 a month. That means that they're getting $1,000 a month. And let's say that they only have to pay out $5,000 in the year to fix things, right? So they made a bunch of money. Okay, so insurance companies do make a lot of money, but they're also very strict with the people that are paying. So if you get in an accident, well, you're out. Okay, you're too much of a risk. So insurance works like that. They work on risk. If the policyholder, you see where we're at after the face value sentence, if the policyholder does not die before the expiration of the term policy, he will get nothing. Like I told you, it expires. Term insurance is the best type of life insurance since you get more coverage at a minimal cost. Okay, so they say it's the best, just so you know. If renewable term is purchased, the policyholder will be allowed to renew the term insurance at a higher rate. Okay, so let's say that you buy it for 5 years, you don't die. Okay, now I want to renew it for 5 more years. Okay, the rate is going to be higher, but you can renew it. You're not kicked out of it and have to find new insurance. The rate increases because the policyholder is older, so there's more risk there, okay? Of course, the policyholder may not need as much coverage since his children may be grown. The difference between the cost for term insurance and the cost for other types of life insurance should be invested. Okay, so if you save on buying term insurance, invest the rest of your money. The two types of lifetime policies, so you remember there's term, lifetime, and endowment. So now we're talking about lifetime, which offer protection for the lifetime of the insured, are straight life and limited payment life. Okay, so it's confusing, but you can always talk to a banker about the differences between them if you don't remember, right? Straight life insurance is usually paid for throughout the life of the policyholder. Payments remain the same, and the policy cannot be canceled by the company due to the failing health of the policyholder. Okay, so this gives you security. You're paying throughout your whole life. Straight life is direct. Okay, you're paying throughout your whole life. It's not going to change. They're not going to cancel it on you, even if you get sick. The beneficiary receives the face value of the policy at the death of the policyholder. Lifetime policies do not consider that the coverage needs change during the life of the policyholder. Most older couples need much less coverage once their children are grown. Okay, so the thing with lifetime is that you are locked in. You're trapped into what rate you chose when your kids were younger. So let's take for instance, you have younger kids. Obviously, they're going to need more money for being way dependent on you if you die when they're young. So you're going to have a big rate when they're young. But if you die when they're older, then you actually were overpaying for your insurance because you were locked in since they were young. Okay? Limited payment life is similar in coverage to straight life, except payments are made for a limited number of years, usually 20 or 30. Unlike term insurance policyholders, the limited payment life policyholder continues to have protection after the payments have ceased. Okay, so limited payment life means that you're not paying for your entire life. You do pick a certain amount of time that you pay. It's going to be at a higher rate though, okay, because you're only committing to pay for 20 to 30 years. But then what if you live past that? Then you still get the benefits. So that's a huge risk to the insurance company. The annual cost for limited payment life is higher than it is for straight life, like I just said. Most young families would find it difficult to make the payments for limited payment life and would probably be wise to invest their savings elsewhere since the rate of return is low on an insurance policy. Okay, now we're into third one, endowment. The endowment policy is both a savings plan and a life insurance protection. It is the most expensive type of life insurance, okay, because it's both savings and life insurance, with payments even higher than those of limited payment. The policy holder makes payments for a limited number of years, usually 20 or 30. If he dies before the end of his period, his beneficiary receives the face value of the policy. If he lives beyond the payment period, he receives the face value of the policy. Okay? So basically, like, you win, right? You outlived how long your life insurance policy was supposed to go for. So now you get all of that money. Okay? Even if no one needs it, you get it. Okay? So that's why it's a savings plan. But it's a pretty expensive savings plan. Again, most people would do better to buy insurance and invest the savings, okay? It's true, you should invest it instead to be guaranteed to be able to use it, okay? This one, you only get to use it if you live long enough. Unlike catastrophes covered by other insurances, such as auto accidents and fires, death is a certainty. Therefore, the cost for a given amount of coverage of life insurance is higher than the cost for the same amount of coverage of other types of insurances, okay? Because if someone that's selling you life insurance knows eventually they're going to have to pay you, okay, because you're eventually going to die. However, term insurance has less expensive rates than straight life or endowment, since the policy holder may not die while the policy is in effect. Okay, so it basically goes like this with the expenses, right? You have term is the less expensive, lifetime, and then endowment is the most expensive, okay? And in lifetime, you have the straight life, which is on the barato side, and then, not barato, but más barato, más, more cheaper. And then you have limited, okay, which is more expensive, but not as expensive as endowment. Okay, the rates of a life insurance policy depend upon 4 things. 1, the type of policy purchased. 2, your age at the time of the purchase. 3, your sex, female or male. And 4, the number of units purchased. 1 unit has a face value for $1,000. Okay, so you get to pick your face value. Payments, which are called premiums, we learned that before with insurance, are usually paid annually, semi-annually, quarterly, or monthly. The more frequent the payment, the higher the premium due to increased collection and paperwork costs for the insurance company. So that's interesting, okay? If you're going to be paying monthly so that it helps you pay in time and it's a reasonable amount, it's actually going to cost more in the long term because they're going to charge you for the paperwork that is involved. Okay, they're pretty tech on you. They're going to charge you for everything. To find the annual premium, multiply the annual cost per unit by the number of units purchased. A sample rate for life insurance is given in the table. So let's look at the table. Annual premiums for $1,000 of life insurance. You have, if you're a 15-year-old, it could be any, let's say you're 20, okay? Let's say you're 25, you're established, you want to go buy life insurance. You can do 10-year term. That means that if you die within 10 years, they'll pay it out. If not, you lost it. Okay, that's $5.89 per unit. $12.95 if you do straight life, okay? $23.20. Look at basically doubles. If you want to do 20-year limited payment life, which means what? You pay for 20 years, they cover you for the rest of your life if you live longer than that. So that's a huge one. And then a 20-year endowment, which means that you pay in for 20 years, you get the face value of it if you last longer than 20 years. Why do you think the premium goes up as you get older? Because closer you are to death, okay, closer you are, supposedly, according to age, right? which is, you know, yes, you can die at any time, but it is the leading cause. It is the majority of people would die as they get older, right? So then you're going to be closer to death, which means you need to pay faster to cover that life insurance policy. So let's look at model problem number 1. Douglas Johnson is a 35-year-old college professor with a wife and 2 children, okay, which means he has how many dependents? It's him with 3 more dependents, right? Wife and 2 children. He plans to purchase a $150,000 10-year term life insurance policy. That means that if he dies before the 10 years is up, they pay. If he dies after the 10 years is up, they don't have any obligation because it's term life insurance. What will be his annual premium? Okay, so what do? What did it say right here? To find the annual premium, multiply the annual cost per unit by the number of units. Well, first you need to know how many units he bought. Well, the number of units is easy. It's $150,000. So there's 1 unit for every 1,000. So that's 150,000 divided by what? 1,000. There's 150 units. Okay, 150 units times the annual cost per unit. Well, let's look at the table. He's a 35-year-old, and he bought what? 10-year term life insurance. Okay, 35, 10-year term, $6.91. So you do $6.91 times 150. And that's going to give you your annual premium. Look at number 2. Janet Morgan, a single 30-year-old secretary, plans to purchase a $5,000 straight life insurance policy. Okay, straight life is the one where she's going to be paying for the rest of her life, and they'll cover her, okay, for $5,000. They'll cover her. She wants to make monthly. Why did she only pick $5,000? Because she doesn't have any dependents, okay, which means that what is that $5,000 going to go for? Paying her funeral. Which is like, it's not fun to talk about this kind of stuff, but it's important to be prepared so that someone doesn't have to pay $5,000 out of their own pocket that they haven't saved because she dies suddenly, right? Her mom or dad or a sister or something like that. She wants to make monthly payments rather than an annual payment. She must pay an 8% increase to pay monthly, okay? It's just the way it goes. She needs to pay monthly so she doesn't have to guarantee that she has the money in the bank at the end of the year to make the payment, right? But she is going to be charged more because of that 8% increase to pay monthly, okay? So watch what's going to happen. Look, I'm not going to put it on the board because you can see it right here clearly. How much will each monthly premium be? Well, first of all, how many units did she buy? 5. 5,000 divided by 1,000. She bought 5 units, right? She pays, let's see, she is 30, right? Yep, 30. That's going to be, for straight life, $15.95? No. Oh, pardon, look what it says. For female, use the same rate as a male, but who is 5 years younger. Oh, I didn't see that part before. For female, use the same rate as a male who is 5 years younger. So we're going to go 30 minus 5 is 25. So we're going to look at the 25-year-old rate, which is $12.95. Okay, so we do $12.95 times 5 units. That's going to be $64.75. But there's an 8% increase. So you multiply that times 8 and add it, right? So you're going to actually be paying $69.93 annually. So divide that by 12, and you're paying $5.83 monthly. Not bad for a single person that has no dependents, right? Okay, so that's how you do it. Let's go through it again. You find out how many units. 5. You go to the table and subtract 5 from the age if it's a female. So you get $12.95. You multiply that times 5 for the units. That's how much you're going to be paying, but you need to find the increase of 8% for paying monthly. You increase that by 8%, then divide it by 12 to find your monthly payments, okay? Number 1 on the exercises is $997.50. That's for a male, $997.50. So look at number 3. I'm also going to give you the answer for that one for a female, $353.40. So you can train yourself to subtract those 5 years. Number 7 is $12.47, and the rest of them are word problems. So if you have any questions, just let me know. Bye.